Hello Propenomix people and welcome to day 4 of the Propenomix Advent Calendar for 2023. So today I'm going to talk about arrangement fees and their strategic use and the impact they've had on mortgages this year. So yesterday's video was about the interest cover ratio and the 125% rule around 5-year mortgages. You can go and check that one out if you don't understand what the ICR is. But today, as I say, it's about arrangement fees, and they've been very much in the forefront of the news this year in the property industry, because we've moved from a world where there might be a 1 or 1.5 or perhaps 2% arrangement fee to a world where there might be a 5, 6, 7% fee, and there are even some products with 10% fees out there, which are quite incredible. And I also think quite risky, but I'll talk about that later on in the video. So why have these huge fees come about? Is this just because of inflation and the lenders are trying to gouge prices and all the rest of it? No, that's not the case. They've actually been trying to fit within the ICR rules, because most lenders understand that the average let property in the UK yields 6% if you're lucky. Especially when you're considering stock down in London and the southeast, you might be looking at yields of more like 5%. And if the base rate is 5.25, well, bear in mind the lenders have got to stay in business, they've got operating costs, and they'd also like to try and make a profit. Now, although their cost of funds is coming from the swap rates normally, there still needs to be that margin. And for example, I was at a presentation earlier this week where I heard that the cost of funds, including op costs for one of the package lenders, is 6.15%. Now that might have come down a little bit since that presentation was prepared, but that gives you a rough idea of where they're at. So how do they get that 6.15% and still attempt to make a profit? Well, what they've got to do is they've got to price their loans accordingly. We've got the pay rate, but if we're at a 6% yielding property, what can we afford to pay because of the interest cover rules? Well, again, you've got that 125% situation, haven't you? So if we were talking about the mortgage swallowing 5% of the rental yield income, then we'd have to be at 1.25 times 5%, which would be 6.25% yield. And that would, in reality, see you having very little or no cash flow whatsoever. But the maximum you could pay is 5, and that lender's got to charge 6.15. So how does it work? Well, there has to be a loading on the arrangement fee. Now, of course, what we've seen is that some lenders have continued to preserve 75% loan to value when they've got arrangement fees of 5, 6 or 7%. Now, I think this is incredibly risky. What's that doing for us as investors? Well, it's basically saying at a really simple level that over the next 5 years, that first 5, 6 or 7% of capital growth is going to go to the bank. And then we're going to have to survive on the capital growth that's left. So it really is a fingernails play to try and stay in business and keep hold of an asset. It's perhaps not as bad as it sounds if you're asset managing well, and also if you're aware and are making sure you look after your rent rises, because rent is predicted by various places to be up between 25 and 35% over the next 5 years, which will certainly help. Although in year 1 it might not be very impressive, it might well be a lot better in years 2, 3, 4 and 5 as you come to the end of that mortgage. However, look at the lender's risk profile, and this is what they have to consider, of course. If they continue to lend 75% net and whack on, let's say, a 7% fee, well, they've done a loan at 82% loan to value, and that starts looking really, really risky. So the lenders essentially have been taking more risk to try and maintain the same margins. And that's quite difficult at the moment. We're seeing a world where, in order to keep the music going effectively, when the swap rates and the gilt rates, if you don't understand those, check out the first 2 Advent calendars. When those rates have been particularly high this year, when they've been 5% or so, or maybe a little bit more, then the erosion in the margin has been so large, the lenders have really only had 2 choices. They either shut the doors or they start taking more risks to try and maintain their margin. Now, some of the more prudent, sensible, risk-averse, call them what you want, have said, well, hold on, we need to go down to 70% loan to value here, because when we've added on that big fee, we're still at 77%, which is roughly where we've been over the past 5 years, perhaps even 10 years as a loan, and we're comfortable at that level. and that is quite a sensible move. If you're looking at the products where there have been 10% fees, they've really had to come down to 70% max, or more likely 65%. And that's nice and easy. Now, I would suggest that in the average market, that isn't the real risk that the lender takes, because we know that in a typical property market, which is bubbling upwards relatively slowly, that's the typical UK market, then ultimately you have a RICS valuation, which in our experience over the years has tended to downvalue the property between 5 to 7% of what we know we could achieve on the open market. This isn't a criticism of the RICS surveyors. They've got a job to do and their professional indemnity insurance to protect. I've always found it quite handy, really, because ultimately that 5 to 7% below what we could sell it for takes into account the 5 to 7% of frictional costs on a sale once you've considered loss of rent if you've lost your tenant and that's why you're selling it, once you've considered the cost of an agent, including the VAT, and of course the legals, the conveyancing in the sale of the property. So you might well end up with that RICS figure in the bank before there's any tax to consider if you did sell that property. But these arrangement fees, the important message here is not to look at them and go, the companies are gouging prices and get angry with the lenders. Their cost of doing business has increased massively. They would much prefer a world like 2021 where they're effectively paying nearly 0% cost of funds and they're lending them out at 3% or 3.25% plus a modest arrangement fee of, say, a 1%. So their margin there between nearly zero cost of funds and 3.5% once you've considered the arrangement fee, something like that, is 3.5%. Whereas at the moment, some of the lenders are having to work to definitely under 2% margins, and some of them perhaps approaching even a 1% margin once you've considered all their operational costs. And I don't doubt that some lenders in this market are operating at less than a 1% margin when you consider the difference between the cost of funds, delivering a loan, and what you can actually get for it in the open market. But that's the strategic importance and the use of those arrangement fees. Remember that you're trading off your future capital growth, and remember who gets paid first in this situation. And that's why, of course, some people have turned to selling the property. I've preferred to generally look for reasons how we could hold and accept the fact that margins might well be squeezed in 2023. They definitely have been. And also in 2024, but in 2025 onwards, they're likely to improve again to something that looks like a reasonable business. And always remember, this is a particularly long-term game. If you think it's get rich quick, I would encourage you to find something else to do. So I look forward to coming back for tomorrow's video, which is going to be on inflation and its importance on returns for property investors. Thank you.